Today's webinar, we're going to be talking about how to buy a house and take out a mortgage in the UK if you've just moved to the UK and want to know how that might be different to perhaps buying a property in the US and taking out a mortgage there in the US. My name's Nathan Pryor from Partners Wealth Management, and I'll be kind of our host for today. And I've got the delight of welcoming Anya from Dunhill Financial and Rebecca from Partners Wealth Management as well, who will be helping kind of take us through some of the key concepts that we want to talk about. This presentation is being recorded, so you can look back at your favourite parts later on. And please do note that you have a Q&A function during this session. So please do put your questions in there and we'll do our best to pick out some of those as we go or pick up your questions towards the end. Now, before we kick off, I do need to start off by just confirming that this presentation is for information and educational purposes only. It is not intended to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor or tax professional before implementing any strategy discussed herein. So to kick us off, I think we'll start off with a poll. So hopefully our tech support can put up a poll here for you, and please do have a quick look and give us your answers. So whilst that's going through, I will perhaps just start off with a first question to Rebecca. Shall we kick off with you? Some of the people here might be buying a property in the UK for the first time. Shall we just start off by running through how is it that you actually go about buying a property? You've seen something you want to buy. What next?
Okay, well, from what I gather, I've never had a mortgage in the US. It's very different. Basically, quite often when you first start looking at properties with estate agents will ask you for an agreement in principle, which is basically a paper that confirms that you're good for the amount of money that you've offered. For these, you obtain them through lenders. It's basically they do a credit check on you, check that, you know, you're fit and proper purpose really, and that your income is sufficient to support the amount of loan that you want. And that's probably the very first step in the process. Once you've had an offer accepted, mortgages here are quite paperwork heavy. They're very focused on proving affordability, looking at income, outgoings, disposable income, and they are a bit of a minefield. There's not sort of a set structure across lenders. Every single lender has different criteria, different things that are acceptable, i.e. length of time in the UK, the visas you're on, etc. So it is something that you do kind of need to know who to approach depending on your circumstances, really.
Yeah, and so when you kind of say there that mortgage advisors want to check that you're a fit and proper person, one of the things they're going to do is a credit check. Of course, having a mortgage in the past might be one thing that helps with a credit check, but as per our poll, 45% of the people here haven't had a mortgage before. But also perhaps if they had just moved to the UK, they might have had a mortgage elsewhere or a credit history elsewhere, but not in the UK. Can that be something of a concern, or are there ways to get around that?
It is. Some lenders in this country will only lend to you if you have a 3-year credit history in the UK, i.e. you've been resident here 3 years. Some are 2 years, and some will do it pretty much from day one. As I said, they've all got different criterias. With the most important thing really when you do move here is to make sure you're on the council tax, that you open bank accounts, a credit card, whether you use it or not, because the more they can do a credit search on you, even if you've been here only a month, the happier they will be with proceeding. They like to be able to see that you kind of exist in this country. If you know there's no credit on you at all, then it causes issues.
Yeah, right. And let's kind of assume that you can get past that kind of initial credit check thing, and they can look through and say, yes, you're a real person, you have some bank accounts and things like that. What then are they going to be looking at in order to judge how much you can actually borrow, or what offers they're going to give you for a mortgage?
As a general rule of thumb, lenders will lend between 4.25 to 5 times income. Some will go slightly over that. It depends on how much you earn. The more you earn, the more generous they will be, and also the amount of deposit you're putting in. So the higher the loan to value, the less equity, the tighter they will be on their income multiples, because obviously there's more risk to them, especially in the current market where it's predicted that house prices will fall. So it does vary, but they do look at your outgoings and disposable income. So if you've got sort of loans or childcare costs or anything else, they will take that into account when looking at the overall affordability. But as a rough rule of thumb, it's between 4.5 to 5 times income is what they'll loan.
Can they ever look outside of pure income? If people have got, I don't know, perhaps they've got pensions coming in, for example, or they've got dividends from investments or things like that. Is that ever considerable when looking at mortgages?
Again, it is not all lenders. Pension income, it depends on the kind of pension. If it's a guaranteed one, they'll just take it into account. That's fine. If you've got something like a SIP or something, they will tend to use a percentage of the value depending on your age. So the younger you are, they'll use a lower percentage of it for income, because obviously they're expecting you to be drawing on it for longer than if you're older. Dividend income from investments, yes. Not many lenders will, but some will. And you do also get asset-based lending. So if you're a high net worth individual, you have assets worth over 3 million, but your income is kind of a bit sporadic, you might be setting up a company, or you can't really prove your income that way, you can do it on asset-based lending. But again, that's a very small percentage of the lenders that will do it on that basis.
So what I'm hearing is it's not necessarily just as easy as going onto an online search engine and plugging in, I want to borrow this much, and getting a list of banks who say, yeah, sure, go for it.
Especially if you've not been here for 3 years and you don't have rights to reside or settled status or something, no, because a search engine like that is not capable of filtering through lenders that will loan to foreign nationals who've been here a certain period of time or anything like that. And it's also, it will do the basic based on earned income, really. It's what it looks at. So no, it's yeah, I mean, you can have a look at it, just have a see where rates are in the market, but would it actually help you find a mortgage? No.
What are the kind of different options in terms of mortgage structures? Obviously there's going to be an interest rate involved in there somehow, but how are the structures of the mortgages set in the UK?
So again, very different to the US. We historically have been very much 2, 3, 5 year fixed rates is what people have done. With everything that's been going on in, since beginning of the year, really, where everything's been going up and up, and everything's more uncertain. Lenders are now doing 7-year and 10-year fixed rates, which historically didn't really exist. So unlike America, all of our our rates, whether you fix for 2 years, 3 years or 5 years, they will have early repayment charges. So if you decide that you want to repay it or want to get rid of the mortgage, you will have to pay a penalty, which is why historically when rates have been going down, people have been going for 2 years and then switching on to a lower 2 year, etc. Now they're going up, people are much more longer term fixed focused. We do not have really fixes for life. There is 1 or 2 on the market. They are a lot higher, and people, it's not something that we do in this country really, is take a fix for life, so that the uptake on them is very slow. The other rates that we have is, which is people who probably follow the markets a bit more and aren't quite so risk adverse, is we have tracker rates that are directly linked to the Bank of England base rate, and so they will fluctuate as it goes up and down, so it all depends on where you think the market might go. And then we have discounted rates, which are discounted off the lender's standard variable rate, so not quite as liable to move as quickly as a tracker rate, but that's kind of the mortgages that we have. And another big mortgage that we have in this country, which I don't know if you'd have in America, is an offset mortgage, which appeals to people who are self-employed and put money away for tax, or people who get big bonuses, etc. Because a savings account will be linked to the mortgage, and anything you have in that linked savings account is offset against your balance of your mortgage and therefore negates the interest. So that is something that does appeal to people here, which, as I say, I don't know if you have in overseas.
Yeah, and I think that we'll come a bit more onto the offset mortgage when I talk to Anya, because that might help with some of the planning and tax considerations as well. A question that's come in here from the audience is that in the US, lenders frequently sell the loans to other lending providers, which can be a bit frustrating as a borrower, kind of having your provider kind of moving around. Is that something that happens much in the UK? No. So, I mean, obviously we had the big crash in 2007, 2008, when we had everyone standing outside Northern Rock's offices trying to withdraw money. And so Northern Rock, as a result, sold its book. But it doesn't happen very often. I think, I mean, I've been doing mortgages about 30 years. I think I can think of about 3 or 4 lenders that have sold their books in that time. And that's because basically they've withdrawn from the market. So I think you had someone like Bradford and Bingley, a very small building society, really. Northern Rock, which was a one-off, and maybe a couple of other smaller lenders that have literally sort of just pulled out of the market. But I mean, all of the big high street banks and the bigger building societies and stuff, no, it's not something that happens here very often. It's not usual. Yeah. So the question that's on everyone's minds: what are rates doing at the moment, and what kind of rates can you get on a new mortgage deal? Well, after Liz Truss, rates rocketed in October, and for November they've been coming down. We did get up to almost 6% for a fixed rate. Fixed rates are now down to about 4.8 for a 5-year fixed, and roughly the same for a 10-year fixed, maybe slightly higher. 2-year fixes are higher because lenders are basically looking for people to lock in for longer at the moment. And then you have the tracker and discounted rates, which they're coming in at about 3.5 at the moment. So predictions are that rates will peak next summer around 4.5 to 5%, and the base rate at the moment is 3. So I am getting a lot more clients at the moment taking the trackers and discounts, and because if they take a fixed, it is about 2% higher, and sort of gambling on it peaking next summer and coming down again. But I mean, that's obviously a very personal thing, and your attitude, and if you like to know what's coming or not. But that's kind of where rates are at the moment. Yeah, I think it really is a personal thing sometimes with this. Do you pick the tracker or fix it in, but potentially pay a little bit higher, the certainty versus the risk, I guess, isn't it? Yeah. Thank you, Rebecca. We'll come back to you, no doubt, with further questions. If we can put up our second poll, please, and then I'll start with Anya, if I can get some questions over to you. Anya, we've just kind of heard a quick overview of how mortgages work here in the UK, and we're kind of aware that that might be a bit different to how they are structured in the US. You've got some experience with that. Could you just kind of run us through the key differences?
Absolutely. Thank you, Nathan. So the main striking difference that I see is the structures of mortgages in the UK versus the US. Generally in the US, long fixed-term loans are incredibly common. Over 90% of Americans are still going for fixed-rate mortgages, often 15 or 30-year fixes. They get to spread payments over time, so home affordability is definitely great when you have your payments spread out over a longer period of time. But generally, you know, from experience, the mortgage market in the States is very vibrant, I would say. I mean, people refinance all the time for a variety of different reasons, and it's easy to refinance. Maybe you need to take out cash for a remodel or to fund your child's college education, whatever it may be. Refinances are definitely common, and anytime that mortgage rates are going down, you see just increased numbers of commercials on TV wanting to entice people to actually take advantage and lower their rate even by 0.5% or a small percentage point. So that's definitely a key difference as far as mortgage structures. There are, of course, shorter term loans, adjustable rate mortgages for 3, 5, 7, 10-year arms, but they're often used for shorter term financing, of course, if used appropriately. So maybe if you're buying an investment property or you're flipping a house, you just need financing for a few years, that could be a good option. Another key difference is that a lot of the loans in the States won't have prepayment penalties. Not all of them, but most of them won't have prepayment penalties. So again, that's another reason why refinancing is so very common. I was just looking at rates in the States yesterday. As of the average national rate for a 30-year fixed in the States is around 6.8. I was looking at my favorite credit union and what they report, and they're reporting 6.2. So it varies greatly state to state and institution to institution. But another key difference is that the ARM rates or adjustable rates and fixed rates in the States don't vary as much. So they're actually close together. So at that credit union that I was just looking at, fixed rate is at 6.2 and the adjustable 5-year ARM is at 6.1. So again, not a big difference there. Might be another reason why people go for those fixed rates just quite often.
Yeah. Okay. Thank you. Now, as well as potentially navigating that difference in how mortgages are structured in the US to the UK, there's also always the delightful thing of being an American living abroad and adding in kind of tax considerations and things like that. Is there anything we need to be wary of being a US person taking out a mortgage overseas?
Definitely, Nathan. There are a couple important considerations we should definitely keep in mind, because as a US associated person anywhere else in the world, we want to just be sure we're aware of how the IRS, what the IRS may view as a taxable event. So if you have a mortgage on a property in a foreign country and you change the terms of your mortgage, or you make repayments or principal payments on your mortgage, again, the IRS could view such transactions as a taxable event. So you just want to be careful before making those kinds of adjustments. I have an example on the screen in front of us because I thought it's easier to illustrate with an example. And it's really a very simplistic example. So let's assume you're taking out a mortgage. You're a US associated person. You live in the UK. You've taken out the £100,000 on an interest-only mortgage. And let's say that at the time when you took out the mortgage, the exchange rate was £1 to $1.50. Right. So the amount reported to the IRS is $150,000 at the time. Now, let's say a few years later, you decide to go ahead and pay it off completely. It's an interest-only loan, so the principal is still £100,000. But now let's assume that the exchange rate actually did what it did recently. We're around 1.22 pound to a dollar, so or a dollar to a pound. So if that's the case, that £100,000 becomes $120,000 roughly, and that's what's reported to the IRS. So this would result 150 minus 120. This would result in a $30,000 gain that the IRS is going to be looking at, and they're going to be taxing this as an ordinary income gain. So that's possibly a very negative consequence. Now, if we had the situation to be reversed, meaning you had currency losses and the exchange rates flipped, that's not deductible. So definitely, you know, a little known tax trap to be looking out for, especially given the recent change in the exchange rates and the pounds falling towards the dollar generally this year. So that's definitely something to be looking out for when changing the terms of your foreign mortgage.
Yeah, I think that's it's definitely a little one-way trap there, isn't it? And Rebecca mentioned earlier about offset mortgages, and we found that this is something that, because of this, the use of offset mortgages is sometimes of interest to people, because they can use cash to effectively, you know, offset and zero the interest rate they're paying on their mortgage without kind of crystallizing this event, because they're not technically paying off the mortgage. Quick question, Rebecca, if I might, back to you just briefly here. Is there much difference in interest rates between an offset mortgage versus a kind of regular mortgage, if you've got other terms the same?
Yeah, the interest rates are a bit higher, because you're kind of playing for the flexibility really, and the linked accounts and stuff. You're probably looking at about 0.75 higher than a standard interest rate at the moment. There's not that many lenders that do it in the market, but it's something we do a lot of, obviously, because we do have a lot of self-employed clients, and for people like that, it really works. You know, if you're going to use the offset facility, it's worth having the higher interest rate.
Yeah, thank you. Anya, a question here for you. The FX doesn't just affect, of course, the mortgage, it could also affect the house. And in the UK, your primary residence, it doesn't matter if you make a gain, it's 100% tax-free. That's not really the case, is it, if you're reporting to the IRS?
That is very, very true. So if you have an American or US association and you're selling your home in the UK, you may have to pay capital gains taxes to the US. There is, of course, a capital gains exclusion that you may qualify for if it's your primary residence and you lived in it for 2 out of the last 5 years. You could exclude $250,000 of gains if you're single, $500K if you're married. However, that may not cover all of it, because currency fluctuations also come into play. So I have another example I wanted to share today as to how this could possibly play out, assuming that you're a US associated person purchasing abroad, where you buy a property at a certain price, sell it for the same price, but you might have a capital gain to report in the US. So let's take a look at this example. Let's say it's a nice estate you're buying for £5 million, which at a time of purchase is reported to the IRS as $7 million US, given the exchange rate at the time. Again, the real estate value stays flat. So 10 years later, you decide to move back to the States, you sell your estate in the UK. Again, it's valued at the same £5 million, so nothing changed. However, the currency exchange has changed, and let's say the pound has grown by 10% to the US dollars, for example. So again, the purchase price was reported at 7 million. If the pound has grown, the sale price is 7.7 million in US dollars. So now you've got $700,000 gain to report to the US, even though you haven't really made any money on that deal, right? So that's an important consideration. It depends which way the currency exchange is going. But going back to that $700,000 gain, if this was your primary residence, let's assume that you are a married couple, you could possibly deduct 500K off of it. So the gain, goes down to 200K. But still, you just broke even on the transaction and you have to report a gain. So that's kind of leaves a sour taste, right? So we definitely want to be careful with that. Again, this isn't as much of a consideration because since Brexit, the dollar has been generally going up in relation to the pound. But these phantom gains is just something we should be aware of. When currency trends reverse, we'll start seeing this happen again. So definitely to be looking out for, right? And just generally as an American, when you're buying property abroad, you should be looking at something if you're looking to stay there longer term. Of course, it's not to discourage anyone from buying property in the UK. It's just to get you thinking about, what if you cannot afford to pay the capital gains in the shorter term, right? So perhaps looking at properties that you could become rentals if you cannot sell them right away, or just not buying if it truly is very much shorter term. So definitely important things to keep in mind there.
Yeah, and of course, currency is one of those things that notoriously analysts are always wrong in guessing which way it's going to go. Our audience have come down on the side of 57%, thinking that the pound is going to grow and get stronger from here. But hey, who knows? So yes, just something to be mindful of there. Anya, is there anything else that you can think of that people should be aware of in terms of being American buying in the UK or in relation to kind of any of the differences between the US and the UK?
Yeah, there are a couple of additional considerations to keep in mind. A frequent question from those that are buying abroad or selling properties in the States, maybe moving to the UK, would be if they could exchange or avoid paying capital gains if they 1031 exchange their property. But those exchanges do not work on international properties. So that only works if you're in the States. So definitely something important to keep in mind. And another question that we sometimes hear is, what if I just don't report my foreign property sale to the US? Definitely not something we're advising, because global transparency is definitely here. So not reporting your property sale might just become more costly for you than you realize in the longer term. So definitely keep that in mind. And then lastly, some might be wondering if they should be purchasing property within their IRAs or individual retirement accounts that are US based. And generally, we do discourage that, especially when it's your primary home. Again, IRS will deem that to be fully taxable, and therefore it should not be in an IRA. So that really invites an audit. So steer clear of that. But those are some of the main traps to be aware of as an American buying abroad.
Yeah, I'll add one more thing in, which isn't necessarily the topic of this seminar, but another thing to be mindful of if you're an American and not domiciled here in the UK. Be mindful of bringing funds into the UK to buy a property here that creates a UK estate from an inheritance tax point of view. The inheritance tax-free band in the UK is only £325,000, which is quite different to what it might be in the US. So that's something to also be aware of when bringing funds here. Thank you very much. Let's put up our third poll, if you don't mind. And whilst you're doing that, I'm going to ask a question to Rebecca from our audience. And I think this is in relation to equity release mortgages. I think it's called a reverse mortgage in the US. Equity release in the UK. What kind of times do people look to do that? Is it something that you're seeing more of in relation to people using their property to finance retirement?
Definitely a growing market. It's only available to people 55 and over. And the interest rates, rather than being linked to the Bank of England base rate, they are linked to annuity rates. And so rather than banks offering lifetime mortgages, it tends to be pension companies that offer them. They've also gone up quite a lot this year, but like interest rates on normal mortgages are coming down at the moment, where everything's getting a little bit more stabilised. They work completely differently. There is no looking at income or affordability or anything like that. It's purely asset-based lending. They will lend a certain percentage of the value of your property depending on your age. So at 55, they would loan a lot less than to someone at 75, because obviously they're expecting that the mortgage will stay in existence for a lot longer. And typically you don't pay the interest just rolls up and gets added onto the loan, which is why they will loan less if you're younger than older. But you can choose to pay the interest. That's also an option. So the initial loan you take out doesn't ever increase. But yeah, it is a growing market, and I think with all the predictions for next year, the recession and everything else, I think it will be even more in demand, where I think you get older people helping out children that might be struggling a bit more financially.
Thank you. Thank you for answering that poll about whether it's better to add to your pension or repay your mortgage. A 50-50 splits there, which is quite interesting. And I think the reality probably reflects that it's a very personal decision. It will be different for different people. Buying a property and taking out a mortgage is, of course, quite a big part of someone's financial life. And it might be something that's quite significant, a significant change in your finances as well. Rebecca, what other things do you find people are typically doing when they're buying a mortgage? And I'm thinking probably around the idea of kind of financial protection and things like that.
Yeah, well, financial protections is a big thing in this country. So when you take out a mortgage, there's probably the three biggest policies that you can have. So one is life cover, obviously. So if you die, the mortgage is repaid, and an additional fund left for the family if necessary. The second one is critical illness, which this tends to pay out if you're diagnosed with a certain illness. These policies have improved a lot over the years now, so that they pay out on a lot more diagnoses than they used to. And often they'll pay out a percentage. So if you're diagnosed with a cancer that is predominantly curable, they'll pay out a percentage of the value that you insured, because they do expect you to be back at work probably within a few months. And the last one is income protection. So this one, if you're unable to work due to illness or injury or disability, they will pay out a percentage of your income, and they will pay it all the way up to retirement, or you can pick shorter term plans where they pay out for sort of 2 to 4 years if you like, which obviously costs less. And they typically tend to pay out around 60 to 65% of your income before you got ill, because obviously they don't pay out the full amount, or there's no incentive to go back to work. And that's a big one, because the benefits in this country, you know, if you don't have something like that in place, will not be sufficient to cover the cost of a mortgage and everything else. I mean, there's lots of different plans. You can do sort of family income plans, and you can sort of pick little bits from little bits and do like a merger of all different bits that you want covered. But they are kind of predominantly the three big ones that people tend to take out associated with mortgages, to make sure the mortgage is cleared if they're ill or upon death, and also to protect their income if need be.
Yeah, well worth thinking about. Everybody, please do keep bringing the questions in, and we'll kind of go and kind of fire off some more questions here to Anya and Rebecca. Rebecca, I'll start with one here for you. You spoke a little bit earlier about one of the things to try and do when you get to the UK is to try and kind of establish yourself here. One of the things you mentioned is about trying to get on the electoral register, which can sometimes be hard when you've kind of first just arrived. Can you just recap for us, what were the other things that you should be trying to do? Because
so on the council tax, so make sure you're definitely on the council tax register, which you should be. But sometimes there is issues with this. So wherever you are, get on the council tax register, which is the equivalent to being on the voters register, really. It will keep lenders just as happy. Make sure, definitely bank accounts, definitely would take out a credit card, whether you're going to use it or not. And ideally do use it, but clear it every month, because the more that they can see that you're using a credit card, but you pay it off every month, then they can see that you're a good credit risk. So just, I'd say they are the three big ones: get a credit card, get on the council tax, and obviously bank account.
Yeah, no, I think that's a good one. And just using the credit card, even if you're paying it off and you don't need it as a loan, actually that's seen as a positive rather than a negative, that you're using credit frequently, isn't it? Yes.
Yeah, it is. If people start using credit cards to withdraw cash, then instant red flag. Why are they doing that? But yeah, if you're clearing your credit card every month, it's leaving a credit trail so that they can check you easier. So it's beneficial.
And would you suggest that there's certain things perhaps you want to make sure you perhaps don't do to work against you? I'm thinking like taking out a car loan, for example. Would those be negatives?
No, a car loan's fine. The only time it would be a negative is if you think that you're going to be pushing the limits of affordability with a lender. So if you've got a car loan that's going to cost you £500 a month, say, how lenders tend to look at it is they will times the car loan by 12 and then deduct that from your income before applying the multiples. So rather than, okay, so it's costing you £6,000 a month, but with the income multiples of 5 times, it's actually going to take 30 grand off what they'll lend. So it's, yeah, I mean, the more sort of credit you have, so they can check you, the better, unless you're going to be sort of pushing the income multiples and it's going to be tight for what you want to buy. Then try and keep things like that down. Yeah.
Okay. I've got a question that's come in here, which perhaps we'll each try and answer and see where we think. Do we expect real estate prices to go down with the growing mortgage rates in the UK? So that's an interesting one. Do we think that because interest rates are going up on mortgages, it's going to start pushing house prices down? Anya, do you have any thoughts on that?
Well, generally, if we're looking at the US markets, that's exactly what happened. We're definitely seeing a stagnation in sales in the US, and prices did definitely ease off, especially last month, when we've seen a fixed rate right around 7%. So to my mind, as these mortgage rates move up, that definitely affects real estate prices in the States. Becky, what about the UK?
Well, definitely. Predictions are that house prices will fall next year. I mean, the main predictions are that interest rates will peak next summer. They're not expecting a huge rise. I mean, the base rate is at 3% at the moment. I mean, the next monetary committee is on the 15th, and they expect it will probably go up by 0.5. So 3.5%, and they reckon it will probably peak by next summer at 4.5 to 5%. So, and then they're expecting the rates will start to come down again. But yes, it's definitely going to have an effect on house prices, because I mean, if you was looking to get on the ladder and if rates are still going up, then it would make sense to kind of wait to see what happens, and so then that knocks through along the chains. So yeah, I think it's going to be a slow 6 months to next year, and then I think it will start to recover.
Yeah. The UK is an interesting kind of property market, isn't it? There's different segments that just move in completely different directions depending on who's purchasing them. I think one of the things that we always kind of bear in mind is that there is a general housing shortage in the UK, but that is at the kind of the entry level first-time buyers, isn't it? So actually, those are probably the people who are mostly affected by higher interest rates, and therefore slows down perhaps the growth in rate prices at that end of the market. I see that Brian's joined us here, so we can hear some of his wisdom on this topic as well.
You're going to hit me on one of my favorite topics, valuations. It's always going to be fun. So, a couple things to break down on there. I'm getting a weird echo. I don't know why I'm getting that. Cam might be able to sort that out. Apologies. On the, let's see if that's any better. Can you guys hear me?
Yeah, that's much better.
Perfect. Sorry about that. So you're spot on, Nathan. Demographic issues are really driving this, and we saw the biggest number of people moving into the country last year, 504,000 shift in population, and there's still a 3 million person shortage of homes in this country, which is mostly made up of the elderly population not moving out of their homes because of a misaligned tax system that doesn't increase the taxes over the course of time based on the value of the home, but instead based on the historic purchase of the home. So you have essentially 3 million bedrooms not being used and a 3 million shortfall of bedrooms, which is why our government doesn't want to allow them to build those 3 million bedrooms in the meantime. So for the next 20 years, we have to sit in limbo of being in a housing shortage. That all being said, with everything going on, we saw yesterday's numbers of real estate values in the country dropping by 1.4%. But our question at lunchtime today was, do you know what the average price of real estate is in the UK? It's right around £220,000, because there's really two markets. There's London and the rest of the country. And I know that's an oversimplification, but essentially there's more potential movement in London than there is in the rest of the country in certain regards, of which I would put the prediction that we're either going to see a housing pullback in a large way. The Bank of England has said that could be as much as 20%. Most of the major banks are holding reserves for their losses of up to 30%. They tend to be a little bit overly cautious so that they can go ahead and take back those profits in a couple quarters from now. And that's not just because we put out in our newsletter that the financials should be doing really well next year, and we'll be adding to them. But essentially, I would expect that the pound will either continue going down, so going on from 200 years to 201 years in a row, that we have a falling pound, or essentially real estate will pull back. We're not predicting which one that will be, but one of those two will most likely happen.
Thank you, Brian. If anybody's got any other questions, please do fire them in. We're out of questions on our Q&A list at the moment. Brian, I don't know if you heard kind of what we were kind of talking through on the way here. Were there any other points that you thought you would kind of highlight or
yeah, it sounds like Rebecca told you that you need to be buying me some beers on your credit card so that you get a good credit score. I think that's how I understood it, right, Rebecca?
Yeah, I think it was something along those lines, but maybe the other way around.
Very expensive beers.
I'll always buy you a beer, Nathan, anytime you want. No, it's been a brilliant presentation. I think real estate is one of those concepts that in simple forms, if we're thinking longer term that markets are going to be more flat. In the US, we would say, don't buy a house unless you're going to live there for at least 3 to 5 years. If you go abroad because of those extra currency risks, I just expand it to 5 to 7 years. It's not something to try to speculate on in the same way that you might be able to do in your home market. So a little more to think about, but with Rebecca's help, with Nathan's help, and Anya's insight, I think it's definitely a big part of your financial plan. Yeah.
We've got one last question that's just been popped in here, so thank you very much. We'll take this question before we end. Is there a part of England that you see Americans buying into more than others? So I guess that's where people are coming over to the UK to live more than others. I mean, my sense to that would be that quite often people generally move to the UK probably due to work, and so they're quite often it's coming in and it is buying into, or at least renting in London or the southeast. Would you say the same, Brian?
Yeah. I think with all the international communities here in London, they tend to follow the international schools. So the American schools being on the West End over by Putney and Richmond, I tend to see a lot of Americans living on the West End of London. Maybe it's just because they're wanting to follow Ted Lasso and Richmond FC, but they still don't find that funny that I point out Twickenham Park as Richmond FC's stadium. So if you haven't seen Ted Lasso, you have to. You also get a lot of them out in the Cotswolds because of the MI5 headquarters out there. There's a lot of people on assignment out there and a lot of businesses following over there. So those are the two regions that I'm seeing a lot of Americans, but then they spread out because they meet a nice, lovely English spouse, and then they can be anywhere they want to be.
Indeed. Well, thank you everyone for joining us today and for your questions. Anya, thank you very much for your insights. Rebecca and Jules as well. If anybody does have any further questions, you've got contact details there on the screen, so please do reach out to any of us and we'll be very happy to help you. Otherwise, hopefully we'll see you next time on whichever webinar you join next.